Most traders approach market panic with the seductive yet dangerous assumption that falling prices automatically create buying opportunities. Yet 90% of retail participants lose money during crashes, precisely because they mistake orchestrated chaos for genuine discount sales. This widespread delusion transforms what should be protective caution into reckless capital destruction, feeding the very mechanism designed to separate weak hands from their holdings. Richard Wyckoff observed a fundamentally different reality through decades of disciplined tape reading and market observation. Panic episodes are not accidental disruptions or emotional accidents, but carefully orchestrated examinations designed by what he termed the composite man to test who possesses genuine conviction versus those operating on hope and impulse. This collective intelligence of large professional operators understands that retail traders respond predictably to sharp declines, rushing to buy perceived bargains at psychologically comfortable levels while abandoning systematic analysis for emotional reactions. The composite man exploits this predictable behavior, creating the liquidity necessary for smart money accumulation at truly advantageous prices. Where amateurs see spreads exploding and volume signatures roaring as clearance sales, professionals measure the precise relationship between effort and result, reading how hard price is pushed versus how far it actually travels. This distinction separates protection from destruction during manufactured crises. Wyckoff developed 10 golden rules through direct market experience that convert panic from an emotional ordeal into a diagnostic opportunity, replacing fear-based guesswork with logic-based observation. These principles reframe hysteria as structure demanding obedience rather than chaos, requiring heroism, because hope without evidence represents disguised recklessness. Like fire insurance, these rules function as small, recurring premiums that permit capital to endure catastrophe, whereas uninsured confidence produces one spectacular error that erases decades of modest victories. True opportunity emerges not from falling prices themselves, but from observable evidence that selling pressure has reached genuine climax. Wyckoff's law of effort and result transforms market panic from emotional chaos into systematic diagnosis, serving as the master filter that enabled his calm navigation through periods when others surrendered to fear or greed. This foundational principle establishes effort as the energy expended through volume and intensity, while result measures the actual price progress achieved through spread magnitude, closing location within the range, and structural advancement or deterioration. During panic episodes, this law reveals the critical distinction between authentic supply, overwhelming demand, versus professional absorption, masquerading as weakness. When climactic volume produces wide spreads closing decisively near session lows, the effort-result relationship confirms genuine selling pressure demanding respect rather than opposition. However, when massive effort generates narrow spreads with failure to penetrate previous support levels, or when enormous volume produces minimal downward progress, the law signals that smart money quietly absorbs retail panic at favorable prices. Wyckoff observed that great effort producing poor result indicates impending character change, the precise moment when market behavior shifts from one phase to another. This insight provides intellectual safety by converting terrifying volatility into measurable diagnostics, disarming both paralyzing fear through objective criteria and destructive greed through demanding proof before action. Context determines interpretation, since identical volume statistics read differently after established distribution versus reaccumulation patterns. The law generates three immediate protective protocols. Respect backdrop structure first, recognizing whether preceding action represented distribution or accumulation, since the same effort-result patterns signal opposite meanings within different contexts. Define danger points clearly before any engagement, trading only where hypotheses can be disproven by price action rather than hope or opinion. Apply real-time effort-result analysis continuously, recognizing that massive effort with minimal downward progress implies absorption, while decisive effort with substantial result confirms continued markdown, systematically converting market noise into actionable intelligence. Wyckoff's law of effort and result transforms market panic from emotional chaos into systematic diagnosis, serving as the master filter that enabled his calm navigation through periods when others surrendered to fear or greed. This foundational principle establishes effort as the energy expended through volume and intensity, while result measures the actual price progress achieved through spread magnitude, closing location within the range, and structural advancement or deterioration. During panic episodes, this law reveals the critical distinction between authentic supply overwhelming demand versus professional absorption masquerading as weakness. When climactic volume produces wide spreads closing decisively near session lows, the effort-result relationship confirms genuine selling pressure demanding respect rather than opposition. However, when massive effort generates narrow spreads with failure to penetrate previous support levels, or when enormous volume produces minimal downward progress, the law signals that smart money quietly absorbs retail panic at favorable prices. Wyckoff observed that great effort producing poor result indicates impending character change, the precise moment when market behavior shifts from one phase to another. This insight provides intellectual safety by converting terrifying volatility into measurable diagnostics, disarming both paralyzing fear through objective criteria and destructive greed through demanding proof before action. Context determines interpretation since identical volume statistics read differently after established distribution versus reaccumulation patterns. The law generates three immediate protective protocols. Respect backdrop structure first, recognizing whether preceding action represented distribution or accumulation, since the same effort-result patterns signal opposite meanings within different contexts. Define danger points clearly before any engagement, trading only where hypotheses can be disproven by price action rather than hope or opinion. Apply real-time effort-result analysis continuously, recognizing that massive effort with minimal downward progress implies absorption, while decisive effort with substantial result confirms continued markdown, systematically converting market noise into actionable intelligence. The effort-result foundation reveals panic's hidden architecture, transforming apparent chaos into a predictable sequence where each phase telegraphs the next through observable volume signatures and price behavior. Selling climax announces itself through climactic spread and capitulative volume, yet the trained observer reads beyond surface violence to detect subtle shifts in character as final thrusts fail to extend proportionally, suggesting professional absorption meeting public capitulation. This terminal exhaustion produces not relief but measurement opportunity, as the subsequent automatic rally establishes the upper boundary of what becomes the trading range, where smart money conducts its systematic accumulation campaign. The secondary test descends to revisit climactic lows with renewed selling effort, yet here the law of effort versus result reveals its diagnostic power through diminished results despite apparent weakness. Volume contracts, spreads narrow, and prices often refuse to penetrate previous support despite the appearance of continued selling pressure, signaling that supply has been largely absorbed during the climactic phase. This divergence between effort and result marks the character change that separates accumulation from distribution, converting fear into systematic observation for those who understand the underlying mechanics. Professional operators frequently engineer a spring manipulation, deliberately violating obvious support to harvest liquidity from stops placed at psychologically comfortable levels. This calculated undercut appears as genuine breakdown to untrained eyes, yet demonstrates narrow spreads and quick recovery, revealing that artificial supply meets genuine demand. The spring serves as bait for both bargain hunters and stop-loss sellers, creating the liquidity necessary for smart money positioning while shaking out remaining weak holders who survived the initial climax. The test phase provides final confirmation as prices return to spring levels, with lighter volume and decisive rejection, proving that selling pressure has been genuinely exhausted rather than temporarily suppressed. Patience becomes the essential discipline since the first low represents theater rather than opportunity, while the spring and its subsequent test offer safer danger points with precise invalidation criteria, systematically converting uncertainty into campaignable structure, where risk can be measured and capital protected through evidence rather than hope. Test confirmation transforms analytical observation into systematic execution, demanding mathematical precision rather than emotional impulse as the foundation for all subsequent position building and risk management decisions. The transition from diagnosis to engagement requires disciplined protocols that honor structural evidence while protecting capital through predetermined danger points. Since even sound Wyckoff analysis faces market uncertainty that demands respect rather than arrogance, initial positions emerge small and cautious at successful test confirmations, acknowledging that proximity to invalidation creates asymmetric risk-reward profiles, where modest size combined with tight stops generates the mathematical foundation for profitable campaigns. Cause measurement becomes the non-negotiable prerequisite before expecting substantial effect, since targets without underlying accumulation represent dangerous fantasy rather than mathematical probability. The trading range width multiplied by time duration generates realistic objectives through point and figure calculations or measured range projections, converting wishful thinking into evidence-based expectation, where imagination never outruns observable energy storage. This cause and effect relationship prevents the amateur practice of buying first and justifying later, instead demanding proof of sufficient base-building activity before committing significant capital to any campaign hypothesis. Systematic scaling replaces impulsive position sizing with methodical building that rewards structural confirmation while penalizing emotional decision-making during market stress. Additional commitments occur exclusively when last point of support validations demonstrate campaign progress, when breakouts confirm genuine character change, or when successful backup to edge of creek patterns validate original hypotheses through observable price and volume behavior. Never during volatility spikes when emotions compromise judgment and spreads widen beyond reasonable risk parameters, since disciplined operators understand that opportunity requires patience rather than urgency. Capital protection operates mechanically rather than discretionally, with hard stops positioned beneath test lows and time stops implemented when campaigns fail to demonstrate expected progress within defined windows, removing corrosive emotional interference from protective decisions. Risk-reward asymmetry becomes mathematically enforced through minimum 3-to-1 expectancy requirements, achieved through danger point proximity combined with measured cause calculations that justify position size and scaling methodology. This systematic approach converts market engagement from gambling into professional campaigning, building positions methodically while trailing stops beneath successive last point of support levels, protecting accumulated gains, as structural evidence continues validating original hypotheses through the eternal relationship between effort and result that governs all sustainable market success. Even with structural mastery and mechanical precision achieved, the human fault line opens at the first tremor of panic, revealing that markets rarely break traders through external force, but through the internal saboteurs of fear, hope, and ego, disguised as prudence, conviction, and wisdom. Fear exits campaigns prematurely, celebrating small survival instead of patient accumulation, abandoning successful tests at the first green candle because the memory of recent loss weighs heavier than the logic of cause and effect relationships that justify systematic position building. This emotional interference transforms carefully constructed setups into nervous scalping, capturing minimal rewards from substantial analytical work while missing the markup phases that justify the diagnostic effort and risk undertaken during accumulation. Hope operates as the more seductive destroyer, encouraging position initiation at psychologically comfortable round numbers, while abandoning backdrop analysis and effort result discipline in favor of wishful thinking masquerading as value recognition. This bias drives premature buying during obvious distribution patterns or continued markdown phases, converting apparent bargain hunting into systematic capital destruction through fighting established character without structural evidence of genuine change, ignoring the very principles that separate professional operation from amateur speculation. Ego completes the destructive trinity by arguing with tape evidence, adding to losing positions without structural justification, and refusing time-stop discipline when campaigns fail to demonstrate expected progress within reasonable windows. This psychological interference transforms protective protocols into discretionary suggestions, allowing pride to override systematic protection until manageable losses become catastrophic account damage that eliminates future opportunity entirely. Behavioral guardrails provide practical antidotes through pre-commitment to single hypotheses with defined danger points and scaling plans, mandatory trading breaks after consecutive losses to prevent emotional compounding, and elimination of news-driven improvisation that abandons systematic analysis for headline reactions. Write invalidation prices directly on order tickets, rehearse panic scenarios during market closure, and log effort result, anomalies, rather than narrative interpretations, because discipline conquers emotion through structure rather than willpower, converting market engagement from emotional ordeal into systematic professional practice, where hope transforms into patient accumulation, fear becomes prudent risk management, and ego surrenders to observable evidence that generates sustainable profits through repetitive application of eternal principles. The 10 golden rules converge into unified doctrine that transforms market panic from emotional ordeal into systematic professional practice, demonstrating how Wyckoff's eternal principles of supply, demand, cause, and effect operate with mathematical consistency across all market cycles, regardless of external circumstances or manufactured hysteria. This comprehensive integration begins with interpreting panic through effort-result analysis, distinguishing genuine supply overwhelming demand from professional absorption masquerading as weakness, then demands structural evidence through the precise sequence of selling climax, automatic rally, secondary test, and spring confirmation before any engagement occurs at clearly defined danger points, where risk becomes quantifiable and asymmetric. The systematic progression honors backdrop structure first, defines invalidation levels clearly, reads effort versus result continuously, waits for character change, confirmation, engages tests rather than hopes, builds cause before expecting effect, scales with structural proof rather than emotion, and defends capital through mechanical stops and time limits that remove discretionary interference from protective decisions. This methodical approach converts market engagement from reactive gambling into proactive campaigning, where positions become systematic accumulation rather than impulsive speculation. Scaling follows last point of support validations instead of wishful thinking, and breakouts are accepted only after observable character change has already announced itself through volume signatures and price behavior, like experienced ship captains reading wind and current beneath surface waves. Wyckoff operators interpret underlying forces that determine ultimate direction, while ignoring temporary disturbances that mislead amateur attention from observable reality. The doctrine becomes personal creed rather than technical method, acknowledging that markets exist to transfer assets from those who hope to those who measure, from those who fear to those who prepare, and from those who argue with evidence to those who accept tape reading as the only reliable foundation for profitable operation. Mastery settles into disciplined humility because the professional edge emerges not from prediction but from systematic alignment with composite man footprints, letting cause, effect, effort, and result provide the speaking, while capital is shepherded through every manufactured storm, with structure conquering emotion through repetitive application rather than heroic willpower.